Good morning, everybody. Apologies for the last minute edit of the slides, but Andrew Matty is joining us this morning, and so he's going to be talking about what's happened over March. It just makes more sense to do it this week because next Friday is obviously Good Friday, so we'll be having a break. So then I'll be talking to Gore Street Energy, which should be interesting. So bit of news first. It's just all results at the moment. I think it's just because people have end December year ends, and then now's about the time that they start talking about them. But actually, Schiehallion, the first one of these, is actually got an end of January year end, so its numbers are even more up to date than most. And they are not great, as you might expect. NAVs there for the boards and the C shares down 24.5% and 18.4%, but much bigger falls in the share price. And obviously, this is mostly, not entirely, but mostly an unwinding of quite high premiums. And so that's been really quite painful for shareholders. And we've seen further discount widening since, even just since the end of January, the odd share discount has gone from 23% to 40%. And there just seems to be a sort of final capitulation of growth stocks at the moment and growth stock investing. Since I think just SVB was the final trigger, but it's really been quite dire. It's surprising, perhaps, that 2 years after they did the C share, we still haven't merged it. They are now 79% invested, and that merges when it hits 85%. I think that there's a heavy hint that it will not far off that happening. So wait and see. When that does do, the odds are on a slightly narrower discount than the C shares are. How that settles in, I don't know, but there may be this looks like a slightly cheap way in to go to the odds, but here we go. I put the picture of the mountain next to the picture of the chart because it's just a bit similar. I think actually the chart's a bit more Matterhorny than Schiehallion, which is more of a sort of syndicate thing. There we go. It's not great. And obviously the discount has emerged relatively recently in that picture. And the NAV, I think, now is trending back towards where it was at IPO. And that's the C shares, not quite so neat a picture, but nevertheless, you get the picture, you get the idea there that this isn't great. This is what's happened to the portfolio over the past year or so. It's become much more concentrated, and I think that's largely a result of valuations of a lot of things falling away rather than them adding to stuff. Some things have been written up in value, and I think SpaceX is definitely one of those. But it is quite a big sort of change from last time. And I think this sort of plays into the theme of we buy these things and then we run the winners, and they're just probably get some more concentrated as they do well. But the things that went down that affected this, there were obviously big falls in the prices of things that had listed and they still had on to. They did write down a few of the carrying values, but not everything. Some things got written up, as I said. And they're also admitting that there's been some poor operational performance in some portfolio companies, so they don't mention any individual examples there. So I'm not quite sure what they're referring to, but we could probably work it out. We can have a deep dive in it. These are the things that fell out of the top 10. The largest of those was Affirm. So this and Warby Parker were both things that listed, and then the share price fell away. So Affirm's a payments company, Warby Parker's like glasses, reading glasses. And yeah, both of them you can see they really haven't done very well. Affirm looks actually really quite dire at the moment. I think it is interesting because what my take on what the managers are saying is that they think we're almost at the bottom, but they don't think we're quite there yet. They are saying, because they've got some cash on hand, obviously, so they're saying they're going fishing, but they're looking interestedly at buying secondaries, so positions in existing companies or funds. I think we're talking about companies here, but at lower prices than they're currently valued at. And they saying that companies should be prepared to raise money at a discount to previous prices. And they're also saying that they're seeing some selling pressure from early investors. And that's the trouble with having a fixed life fund that Schiehallion obviously doesn't have. But if you have got a fixed life fund, at some point you have to give the money back because you have to turn it into cash. And that means you're a forced seller. It's not a great thing to be in this kind of environment. But I think it might imply more NAV declines. But I still think we are getting to the end of this growth sell-off. But they're implying that maybe still more to go for. Now, completely opposite. Global Opportunities, which used to be EP Global Opportunities, and it's been around for a long time, but it's not a very big fund. It's kind of not very big fund because it's always been following this kind of value strategy, and value, as we know, hasn't worked for a very long time. So it's now shifted to the flexible investment sector to allow it to invest in other asset classes, and it's still targeting undervalued assets. Once it finds things it likes, it's going to stick with them, so be quite low turnover. And it's sitting on quite a big cash pile, almost 40% of the fund at the end of February. And that's all down to its manager. There's the chart, which doesn't look too awful when you've just been looking at the Schiehallion ones. But nevertheless, there is a sort of discount play there. Well, that's narrowed a little bit recently. And here's the returns, and you can see why what I meant about value hasn't really worked. So if you're looking at the NAV returns relative to the all share, it really is only relatively recently that it's perked up. So actually, although they're now outperforming over 2 years, you look at the individual calendar years, it's been quite a long time since it actually outperformed, and we're really only talking about the last year when the value thing turned. Of course, there may be more to go for, and they definitely think they are. So Sandy Nairn is the person behind this, and he's sort of turned it into a self-managed fund. So it was managed through Franklin Templeton, but same thing. So he's now left them, and he's now employed by Global Opportunities. They're serving notice on the contract with Franklin Templeton. It then become fully self-managed. He's going to run the listed portfolio. He's got a stake in, I think, of Goodhart Partners that is investing into unlisteds. And just interestingly, that has a stake in AVI. It's one of the things it's doing. It's buying stakes. It's like here, stakes in boutique private capital managers. So I think they're attracted with the Japan story, with AVI Japan Opportunities. So I think that's the reason that they ended up investing in it. And he does have other funds invested into that sort of Japan corporate governance angle, which we know has been doing relatively well recently. But it'll also be making direct co-investments, a lot of equity investments. So here we have something that is also going fishing for bargains in this kind of listed market, but coming at it from a very, very different angle to the Schiehallion one. That's Sandy's view of the world. He's sort of like Uber Bear. Hasn't really changed. It's interesting that he doesn't think we're there yet, but he does say we're not there yet, but we are getting closer. So there we go. Now, infrastructure, just one little thing before I hand over to Andrew Mahaty. Here's the discounts on these funds. All these things were trading on premiums not very long ago. This is really looking quite dire now with some of these. BBGI and stuff, they're handling it relatively well, but there've been quite big share price falls. And so I was really quite surprised in the results for BBGI and international public partnerships that they just didn't mention the fact that the shares had fallen. Well, I mean, IMPP sort of alluded to a discount, but there's no numbers for what the share price returns were in the results, which is just strange, I think. It might be that they're just not used to worrying about it. But I do think it needs to be acknowledged and tackled. And more needs to be done on discounts. And it's interesting that the two funds that we work with, so GCP and Pantheon Infrastructure, are both either, well, GCP's already started a £15 million buyback, and Pantheon said this morning that it's planning to do something about it if the discount is narrow. I've written something about this for Citywire, so you'll see that on Monday. I'm just expanding on this a bit more. But I think infrastructure, renewable energy infrastructure, it is a bit daft now. One of the funds that isn't, though, we've been talking to in a minute, is Wall Street. So, no, it wasn't supposed to be in there. So let's hand over to Andrew.
That's great. Thank you very much, James. Let me just switch over to my screen, and we'll talk about the movers for March. And it was a pretty grim month, as we'll all know, probably. I was quite pleased. I did actually manage to fill a screen full of movers. I wasn't sure I'd get to the bottom of the screen, but they're quite modest. There wasn't really much positive action at all. Few and far between there. Not too much really to talk about. One I will mention, though, is Tetragon Financial Group, because that ties into the theme I'd like to talk about, which is discounts. Clearly, it pays to focus on the fallers this month, which were much more significant. And at the very top there is Hydrogen One Capital Growth, which I talked about last month and highlighted was already a sharp faller in that sector. We witnessed the very rare occasion of a trust putting out an announcement to the London Stock Exchange saying that it knew of no company-specific reason for the share price fall, which we don't see very often in this sector at all. And there has been a modest bounce in the shares since that time, but the results are due next week, and then the next quarterly NAV for Q1 is at the start of May. So there are a couple of sort of proof points coming up which may settle people down there. We'll see. Second on the list is Phoenix Spree Deutschland, which suspended its dividend, which was the headline there, which I will talk about. And then below that, we do have Schiehallion, and that was quite mean, by the way, James, using the mountain picture there. We have Schiehallion and Chrysalis Investments and various other bits of growth capital there, which obviously have suffered in the wake of the SVB collapse. So anyway, Phoenix Spree Deutschland is the one I'll focus on. But it was overall a very tough month. Sector was down about 5% or so. And one thing I noticed, if we just flip back actually to that list of fallers, there's not a single conventional equity trust on that list. It's all alternative assets. So it's growth capital, infrastructure, real estate, private equity, no conventional equity trusts at all. And I think it's rather ironic that, I do remember the development really of this alternative asset space, which was trumpeted as bringing extra diversification to us, which would obviously dampen the overall volatility of our portfolios. And these were assets which were never intended to be volatile at all. They're generally considered to be more conservative, I think, than equity markets. But what has happened is that they've actually introduced a lot more volatility to the overall sector. And the reason for that is obviously the discount volatility, which I think is probably quite unexpected, but clearly prices have been marked down ahead of the curve, I think, so that they're anticipating big falls in NAVs. And that's why this reporting season is so interesting, actually, because we're seeing whether that is the reality or not. But we can see from this the chart here is a 2-year chart plotting the investment trust sector in black against the FTSE All World Index in blue. And they tracked each other reasonably faithfully until this recent period, actually, where we've seen discounts really widen out, which I think, again, has implications that we may be reaching that point of capitulation where actually prices are being marked down possibly a bit too much. We'll have to wait and see. But it does more broadly pose this question, which, actually James has just mentioned about discount control in the alternative asset space. And there was quite an interesting note a couple of weeks ago from Peel Hunt talking about buybacks and the fact that very few real asset trusts had undertaken buybacks on any scale. They just mentioned 3 that had, which was Balanced Commercial Property Trust, Keeler European Renewables, and Augmentum FinTech. But generally, of course, these trusts don't like to buy back because it's more difficult for them to sell their chunky assets. but also many of them are just asset gatherers. And they're really seeking, they're trying to build up their asset base so that they can pay out more income. And they never really have in mind that they're going to sell any assets. Asset sales are really few and far between, for example, in the renewables space. And I think at a time when there's this big disconnect between market prices in the terms of share prices and valuations, I think it's a fair point to argue that the best way of establishing whether your valuations are accurate or not is to sell something. And if you sell it at or above your valuation price, then you have a proof point. And that's quite common, actually, in private equity. I mean, interestingly, HG Capital talked about that in their last presentation when they were asked about their valuation methods. And they said, well, look, every time we sell an asset, it's sort of premium to the carrying value. So I think that tells you what you need to know. And that hasn't been the case for the infrastructure trust because they haven't sold anything. So I think there is an argument here for boards actually to be a bit more proactive, because I think the managers are never going to want to sell their beloved assets. But perhaps the boards need to poke the managers into doing that, just to validate the valuations. And the other aspects in the conclusion to the Peel Hunt study was that actually doing nothing on your discount wasn't really the best approach at all. Even if there's some skepticism about whether buybacks work, they found actually, if you look at the discount volatility of the group that did do some buybacks against the group that didn't, it was reduced. So in other words, buybacks have had an effect. And I think they don't have to be massive, which is where Tetragon Financial Group comes in, because this is a really odd trust, which is actually quite consistently on a very big discount. And there are quite good reasons for that. Mainly because the shares are non-voting, and as shareholders, you really don't have much power here at all. And I've attended a few of the results presentations by the managers, where they just flick away questions really about the discount, and they're quite happy getting their quite substantial fees. So whilst the trust is actually quite a decent trust, is performed quite well and has interesting holdings in private asset management companies, which at some point might be spun out, which will really realize value. But until that happens, I think this discount is going to persist. But what is interesting here is that whilst the trust really doesn't seem to have too much intention about doing anything serious about the discount, it has had now 3 or 4 periodic tender offers, which are really small, actually. I mean, they're only buying back a maximum of £25 million worth of shares. And this is a £2 billion trust. So it's a drop in the ocean. However, what they're doing is just signaling to the market that they are thinking about the discount. And actually, at the November tender offer, which wasn't fully taken up, that was a strong signal to the market that actually people weren't willing to sell out at this discount. And that the reason actually why the shares bumped up quite nicely in November by about 20%. And they're currently they just launched another tender offer now, which is perhaps why the shares were on the list of risers this month. So anyway, that's a bit about discounts. And in fact, that really rears its head again now with this faller Phoenix Spree Deutschland, where the headline was very much about the suspension of the dividend, which has been quite rare actually in this market so far. I mean, we saw Target Healthcare rebase its dividend a couple of weeks ago because it was uncovered. That seemed quite sensible. But Phoenix Spree isn't cutting it. It's just it's suspending it altogether. And I think when you see that headline and you see the share price reaction, which is quite negative, down 23% over the month, you think there's got to be something pretty awful happening in the underlying portfolio here. But I think it's worth examining that story, because my feeling is that that's not the case at all. And there's a decent reason actually for the dividend removal. So what this trust does, it invests in residential apartments in Berlin. It's very specific, so you've got to have an opinion on that. it basically buys these large apartment blocks and rents them out. And it has, it's quite chunky. It's 780 million euros. And it's been going now for a little over 15 years. And this is the first time it's had a reduction in its net assets, actually. It's gone up every year previously. And the fall in sterling terms was only 3.2%, a bit more actually in euros. But nevertheless, it's really not a very big fall at all. The gross rental income was up. The borrowing is fine. It's well within its covenants, and actually it's quite cheap. It's only 2.2%. So there doesn't seem to be any massive reason there until you look at the real reason why they were paying a dividend in the first place. And it's very specific, actually, that whilst this started out as a pure rental business, the managers came to realize that actually if they changed the legal status of their apartments to condominiums, they could then sell them. And in a strong market, actually, they could get quite nice uplifts to the asset value that way. And obviously generate then a cash flow, which they used to pay dividends. So they didn't start paying dividends until they started selling condominiums. And this has never really been an income stock. That wasn't really the focus of it. So the yield was only 3% anyway. But what has happened in this recent market is that the proximity to Ukraine, coupled with the rise in interest rates, has really spooked those potential buyers of condominiums. So the transactions have really ground to a halt. So whilst the trust was targeting about 15 million euros of sales, which is what they achieved in the prior 2 years, actually they came in at 4.7 million euros. So a really massive reduction in sales. And I spoke to the managers and they said, well, they could have sold 50 million euro worth, but it would have been at knockdown prices, and that didn't seem sensible. So essentially what's happened here is that because the transaction volume has dropped, they're not generating enough cash to pay the dividend, and they're also concerned about keeping that LTV down. So they're not paying the dividend for now, and I don't think it'll come back for a while. Won't be this year. But nevertheless, it's a very specific reason here why they've cut the dividend or suspended it. And actually, the underlying fundamentals still look quite solid to me. It's very good demand for rentals. There's still young professionals moving into Berlin, low vacancy rates, good affordability. There's quite a strong case here. And I can see someone's just asked why wasn't this explained in the results? It's quite interesting. On the call I was on, which was a group call, I was the only person who asked any questions, and I just don't think there's any interest in it. I think people have just thought, it's European real estate. It's very specific. REITs are under pressure. This is going down. Therefore, I'm not interested. And I think that's what gives you the opportunity. And the discount actually to the EPRA NAV is now 58%, which is really, that's a pretty broad margin there to give you some comfort. However, of course, it could get worse. And actually, it's interesting. There are a number of other listed companies in Germany that are focused on Berlin property, and those are on wider discounts, actually approaching 70%. But I think that's because Phoenix Spree Deutschland is in a better position with its debt structure and also the high proportion of apartments it has converted to condominium status, which is 77%. So I think it's in actually quite a strong position compared to its peers. So my feeling is that there's good value here, but of course, you're going to need to be brave to buy into this when the chart looks as it does here. And you're not being paid to wait, of course. That's the difference between this and many of the other discount opportunities across the sector, that you're not getting any dividend yield here. Nevertheless, I think in the fullness of time, this could well play out to your benefit if you're brave enough now. Okay, I think that's it from me, James. So I'll hand back to you to have a chat with Alex.
Thanks very much, Andrew. Let's share the screen again. There we go. Yeah, no, thank you. I do think it's interesting what's going on with that. But obviously, so that gearing, if the apartment values do fall, that's magnified on the downside. So that's something to bear in mind.